Welcome back to the deep dive. Today, we have assembled what I think is one of our most comprehensive stacks of sources ever. It's a genuine blueprint for accelerated wealth.
It really is.
We're looking at everything from the mechanics of high finance and strategic tax planning, all the way to the philosophical questions about work, happiness, and wisdom gained over a century.
And it's a powerful combination because it forces you, the listener, to confront the inherent trade-offs in financial success. We're zooming right in on these intense, high-octane careers that can pay $500,000.
Right.
And then immediately pivot to the practical steps an average person can take right now to build, say, passive income. And then we try to synthesize all of that into the mindset that really separates the successful from the stagnant.
That's it, exactly. Our mission today isn't just to summarize these complex roles or market forecasts. The goal is to distill a rapid-fire, comprehensive strategy. We're going from the abstract complexity of a billion-dollar merger all the way down to the immediate, practical actions you can take this week.
Things like understanding a bond fund or optimizing your compensation for 2026.
Exactly.
And, this deep dive really highlights an interesting tension that's embedded in the source material. We start in the world of that high-stakes $500,000 career track, the ones so many people are striving for.
Mm-hmm.
But then we immediately look at all this data on why people quit those exact jobs.
Yeah.
So this conversation, it's about connecting the operational demands of high finance with the psychological reality of building wealth and, personal fulfillment.
It's not just about the P&L statement. It's about the quality of life statement.
Perfectly put.
Okay, let's unpack this. We're going to start in the deep end.
Yeah.
The world of work, where the financial stakes are arguably the highest. We're starting with investment banking, or IB. It's a career that's often shrouded in mystery and, let's be honest, defined by long hours and huge bonuses.
Right.
People know it's high-paying, but I don't think they truly understand the core function. The sources we have define the role as fundamentally being the intermediary of capital.
That is the perfect and I think necessary definition. Investment banks, they're the vital link between those who need large amounts of capital.
Like corporations wanting to expand or buy another company.
Exactly. Corporations looking to launch a new product, go global, acquire a competitor, and those who have capital. So institutional investors, wealthy individuals, the public markets, their primary function is just facilitating these major financial transactions.
Can you give us a concrete example of that facilitation?
Sure. So when you hear about a massive merger, say company A is buying company B, or maybe a private company decides to go public with an IPO.
The investment bank is running the show.
They're running the entire show. They advise the client on the valuation of the target, the structure of the deal. Is it cash? Is it stock? Is it both? And they draft all the crucial documentation. They are, at their core, expert deal makers, strategists, and financial architects.
So their work really centers on those two big areas: mergers and acquisitions, M&A, and company sales. It sounds like they need an intense mix of skills.
Oh, absolutely. The sources really emphasize this. These professionals have to combine intense financial expertise. I mean, you have to be able to model incredibly complex scenarios in Excel.
The technical side.
Right, with deep analytical skills to assess risk and opportunity. And then on top of that, extremely sophisticated communication skills. You're advising CEOs and boards of directors.
The stakes are huge.
You have to present these complex, multi-billion-dollar scenarios with absolute clarity and conviction. That's where the value is, translating risk and opportunity into tangible, executable financial plans.
And here's where it gets really interesting, connecting to today's financial landscape. The modern transformation of the industry brought on by data analytics, our research clearly shows this is fundamentally changing how banks operate.
This is such a crucial point for anyone looking at this career path today. Historically, a junior banker would spend years just becoming an Excel jockey, right? Manually building these complex models from limited data.
The grunt work.
The grunt work. But now, data insights are used to optimize M&A deals and strategies from the very beginning. Banks are leveraging massive data sets, both proprietary and external, to predict how the market might react to an IPO, or to assess regulatory risks of a merger.
So the role is shifting from just compiling data to interpreting it.
Precisely. The technology handles a lot of the raw data processing, which means the banker's job is now elevated. It's about interpreting these massive data outputs, developing more sophisticated strategic narratives for clients, and, frankly, validating the technology's findings.
So it enhances precision and speed, but it also probably means the intellectual intensity of the job is even higher.
I think that's right.
And just for context, in this ecosystem, the investment banker works closely with another role, the securities analyst. What's that distinction?
So a securities analyst who might work for a brokerage firm or the investment bank itself, they perform the crucial due diligence and research. That research is what feeds into the banker's advice.
They're the foundation.
Exactly. They recommend investments, evaluate economic trends, everything from broad macro shifts down to the performance of a single company. The occupational outlook for analysts really emphasizes evaluating data, creating detailed models, and providing the informed predictions that the investment banker's advice is built on.
Okay, so now we move from that intense job description to kind of financial paradox. Why would someone walk away from a $500,000 career? This connects directly to our source, I quit my $500,000 job, and these movements we've seen, like the Great Resignation.
This section holds some critical lessons, I think, especially for ambitious professionals. The data, particularly from Pew Research and McKinsey, it cites the top reasons for quitting, and they really force us to rethink the role of money in job satisfaction.
It's not just about the paycheck.
It's not. While low pay is cited, even among high earners who might feel, relatively undercompensated for their hours, the critical factors are lack of advancement and, most critically, feeling profoundly undervalued or disrespected.
Undervalued even at that salary, that seems a little counterintuitive.
It's about the breaking of a psychological contract. If you're working 80 hours a week, generating millions for the firm, but you're excluded from key meetings or your contributions are ignored.
Then the money starts to feel like hush money.
Exactly. It's not genuine appreciation. The sources highlight that the perceived lack of dignity is a major driver of people leaving.
So a toxic culture is the ultimate undoing for a firm financially, regardless of how much they pay.
Absolutely. The MIT research on this is definitive. Toxic culture is the #1 predictor of attrition. It drives resignations more than compensation, more than burnout, even more than job security.
Wow.
And things like unrelenting overload, a lack of control, and just bad relationships with your boss. Those are the underlying drivers. It's often viewed through what they call the approach avoidance lens. You're not necessarily approaching a better job. You're aggressively trying to avoid a bad, unhealthy, or degrading one.
When the stress becomes unbearable, the high salary just isn't enough compensation for the misery.
That's the ultimate financial paradox, isn't it? You earn enough to achieve financial independence early, but the cost of getting there makes you quit early anyway.
But there's an added complication here. The Conference Board survey adds a layer of caution, showing that people who changed jobs since the pandemic are often less satisfied in their new roles.
Right. Quitting a high-paying job is complicated and doesn't guarantee happiness. You might just swap high pay and toxicity for lower pay and boredom, or just a different kind of stress.
But there is a potential structural solution for retention, a silver lining.
Yes. A Stanford study provided really compelling data on this. It found that implementing effective hybrid work models can reduce resignations by a massive 33%.
33%, that's huge.
It is. It suggests that just restoring a measure of autonomy and flexibility helps alleviate that feeling of overload and disrespect, even in these super demanding fields.
Giving people control over where and how they spend their intense working hours is a surprisingly effective retention tool, and probably a lot cheaper than another bonus.
Far cheaper.
So the intensity of that IB track, it leads us to a more philosophical question about the value of work itself. This connects to our source, your job achieves nothing, probably. It makes us engage with David Graeber's theory of bullshit jobs.
Right. Graeber's hypothesis is powerful because it resonates with that Pareto cynicism a lot of white-collar workers feel. The theory suggests a huge portion of the economy is tied up in roles that people privately believe are meaningless or should just be automated.
But the empirical findings in our sources offer a fascinating check on that theory.
They do. Cambridge research tested this perception directly, and the finding was striking. Only about 1 in 20 people, so 5%, felt they were in a completely useless job.
So way fewer than the theory would suggest.
Far fewer. Most people feel their job serves some function, even if it's a bit tangential.
That seems like a contradiction. If so few people feel their job is useless, why is there so much dissatisfaction?
Well, the overall sense of dissatisfaction can remain high, even if the job itself isn't totally redundant. The British Sociological Association confirmed the presence of pointless tasks within certain occupations, and that leads many to feel their work is meaningless.
Ah, so it's the tasks, not the title.
Exactly. The core issue is that many people feel their daily execution is irrelevant or just bureaucratic filler, even if the role itself is necessary for the ecosystem. The search for meaning is separate from the role's operational necessity.
So whether your job achieves nothing is subjective, but the feeling that it does is a powerful driver of dissatisfaction no matter the paycheck.
All right, let's shift from the job itself to the tactical tools and trades you need to build wealth from the outside. When most people talk about wealth building, they immediately jump to the exciting stuff, stocks and high growth.
Right.
But any diversified strategic portfolio has to have a backbone, and that backbone is often bonds. The sources treat this fixed income asset class as foundational. That's right. A bond is essentially a loan. You, the investor, are giving a loan to an entity, a government, or a corporation. In return, they promise to pay you a fixed interest payment over a set term and then give you your principal back at the end.
It's crucial for capital preservation and generating consistent income, and it's typically less volatile than stocks.
Exactly.
So what does the long-term performance data tell us about bonds?
Our sources, drawing from research by firms like S&P Global and Dimensional, they confirm that long-term bonds, on average, earn higher returns than short-term bonds. But it's not just about duration. It's about understanding the factors that are linked to expected returns, like credit risk, liquidity, and term risk.
So while a longer duration might yield more, it also exposes you to greater interest rate sensitivity.
Precisely. That's the trade-off.
So if a listener is evaluating a bond fund, what should they be looking for beyond just the headline yield?
They have to focus on key risk-return metrics. You need to look at the duration of the fund, that's its price sensitivity to interest rate changes, and the credit quality of the bonds inside it.
Yeah.
And a really vital topic right now is the role of ESG, environmental, social, and governance factors.
How does that affect bonds?
Well, the data shows that the ESG profile affects bond return volatility. High ESG ratings often correlate with stability and a lower risk of default, even if the initial yield is a little bit lower.
We often debate active versus passive investing for stocks. Is that debate also happening in the bond market?
It is, but with different results. Morningstar analysis shows that the success rates of active versus passive bond funds shift over time. In really efficient markets or when rates are stable, passive index funds often win out because of their lower fees.
But when things get choppy.
Right. When interest rates are volatile or credit markets are stressed, a good active bond manager can often capitalize on mispricing and credit research, and they can generate alpha that a passive fund just can't capture.
And for anyone wanting to do their own due diligence, where can they find reliable, real-time info?
FINRA provides a crucial public resource, their fixed income data platform. It offers real-time bond facts, pricing, and essential educational info. It's a key, unbiased source.
Okay, shifting from the foundational world of bonds to some high-stakes speculation, we have a source focusing on one of the most bullish predictions out there. Tom Lee's forecast for the S&P 500. This is the kind of call that investors either build entire strategies around or
They vehemently dismiss it.
Exactly.
Lee's outlook is undeniably ambitious. It suggests historic growth is on the horizon. He's predicting the S&P 500 could reach 7,000 or more by mid-2025.
And that's not even the big number.
No. The truly dramatic figure is his prediction of 15,000 by the end of the decade. That implies a staggering 123% upside from today's levels.
That is a massive claim. What's the thesis driving that extreme optimism? It can't just be blind hope.
The reasoning seems to center on Fed policy normalization and corporate earnings resilience. Lee argues the market is undervalued and discounting future growth. He believes the Fed will manage a soft landing, keeping financial conditions loose enough for liquidity to flow back into growth stocks.
And based on this bullish scenario, what specific sectors or stocks is he looking at? We have that source, Tom Lee. Buy these 10 stocks in 2026 and never work again.
Right. The sector picks are crucial. He favors areas with high leverage to economic recovery and tech advancement. Specifically, he's very high on small caps.
Why small caps?
Small cap stocks are traditionally more sensitive to the domestic economy, and they're often the first to see massive gains in a prolonged bull market. He believes this group is severely oversold and due for a historic catch-up rally.
But a smart investor has to consider the other side. What does the bearish counter outlook for 2025 and 2026 say?
The sources present some very significant counterpoints that you can't ignore. The bearish outlook cites three major risks that could completely derail Lee's scenario. First, renewed global trade tensions leading to tariffs.
Which act like a tax and slow everything down.
Right. Second, persistent inflation that forces the Fed to keep rates high for longer than expected. That increases the cost of capital and makes expansion expensive.
And the third risk.
Just general Fed uncertainty. The market hates uncertainty. Any misstep in guidance could destabilize markets. So you have to weigh this high upside potential, that 15,000 S&P target, against these significant structural and policy risks.
High reward versus severe policy risk. Okay, we've talked about multi-trillion-dollar markets. Let's bring it down to the individual entrepreneur with the dream of generating passive income, specifically drop shipping. This is something that gets hyped up a lot, so we need a serious reality check here.
This is where we replace the fantasy with hard data. Drop shipping is incredibly popular because of its low barrier to entry. But the profitability metrics are clear and often much tighter than advertised. Sources citing data from platforms like OddOdds and Printful, they estimate average profit margins are consistently between 10 and 30%.
10 to 30% is a decent margin, but that still requires a ton of sales volume to create significant wealth.
What about the success rate? How many people actually make money?
The sources are pretty sobering on this. Success rates for dropshipping businesses are consistently estimated between 10 and 20%.
So 80 to 90% of people who try it fail.
They either break even or more likely fail within the first year. It's often due to poor product selection, sky-high advertising costs, or bad customer service.
And the scaling challenge must be huge, too.
Absolutely. The data really underscores how hard it is to move from a side hustle to a serious revenue stream. Only a tiny fraction, about 1.5% of dropshipping stores, ever achieve over $50,000 in monthly revenue.
Wow. Only 1.5%.
Right. The vast majority of successful ones are well below that. You have to be in the top 1.5% to get that transformative financial freedom from dropshipping alone.
That figure puts the success in perspective. But the potential is there. And we can't ignore the market context. Despite the individual failure rate, the market is projected to reach almost $3.5 trillion by 2033. This growth is why it's seen as a democratizing force in e-commerce. It lowers the capital barrier. So the pie is getting bigger, but the competition for a slice is ferocious.
Okay, a brief interlude on trading strategies. We had a specific search for trading like Stinson Dean, which suggests a niche strategy someone was interested in.
That's right, and our source searched for that specific methodology. It came up empty in terms of widely documented professional strategies.
Understood. But we can still pull out some crucial general insights on professional trading from our other sources, which is valuable for any aspiring trader.
Indeed. Professional trading, no matter the specific system, really hinges on two core components. First, the essential tools, which include access to real-time data for instant decision-making. In trading, half a second of latency can be the difference between profit and loss.
And the second component?
It's all about robust risk management. It's critical. Successful traders don't just focus on maximizing profits, they focus relentlessly on protecting their capital.
So disciplined position sizing, strict stop-loss orders?
All of it. And maintaining a favorable risk-to-reward ratio. The takeaway is clear. Success in trading is less about finding some secret system and far more about disciplined execution and protecting your downside.
And necessary reminder, discipline precedes profit. All right, moving into foundational multi-decade decisions, let's tackle the massive question facing millions. The rent versus buy calculus.
And in the current climate, with high rates and high prices, this is more complicated than ever.
The current affordability gap is one of the biggest hurdles to building wealth, isn't it?
It's huge. Data from SmartAsset shows that nationally, homeowners are paying, on average, $1,300 more per month in housing costs than renters.
And for a starter home, the cost of just getting into the market is intimidating.
It is. The NAR data confirms this. Purchasing a typical starter home costs over $1,000 more per month than renting that same home once you factor in the mortgage, taxes, and insurance. That affordability gap puts serious strain on first-time buyers.
That initial cash flow drain is immense. But we have to look at the long-term perspective.
Of course. When we look at a 30-year horizon, the sources project that housing expenses generally increase about 4% annually. For renters, that means your monthly payments just keep going up forever.
But for owners with a fixed-rate mortgage, the main payment is stable. It's a hedge against inflation.
A key factor in the long-term wealth calculation.
So when does buying actually start to win the financial race?
The sources offer specific scenarios. Buying starts to cost less than renting for larger properties, specifically places with 2 or more bedrooms. The premium you pay for a larger asset tends to appreciate more reliably. But a 2023 study found that long-term renting was mathematically cheaper in 46 out of 97 cities they looked at, just due to extremely high prices and rates in those markets.
So it's very dependent on where you live.
Highly dependent.
And beyond the dollars and cents, there's a major psychological factor here, which connects to our source. Signs you're doing great financially, even if it doesn't feel like it.
That's the critical piece. The Hamilton Project data noted that renters generally report greater financial anxiety compared to homeowners. So while buying might increase your monthly outlay at first, the stability and equity buildup seem to reduce overall financial worry for many people.
It's a trade-off, immediate cash flow strain versus long-term psychological security.
Exactly.
Now for the strategic fine print of wealth management taxes. We need to look ahead to 2026.
The material focuses on the very real projected IRS inflation adjustments for 2026, which are essential for planning. These adjustments are automatic and they're consequential.
What are the key adjustments we need to be preparing for right now?
We're looking at changes across the board due to inflation indexing. The sources detail specific 2026 adjustments, including anticipated increases to the standard deduction, tweaks to the tax brackets, and changes to capital gains thresholds.
And the alternative minimum tax, the AMT.
And the AMT exemption amounts. This requires active year-end planning now to maximize savings before 2026 begins.
Okay, let's get into the specifics of that. We've got the source, 10 ways to maximize your tax return in 2026. Let's break down that expert checklist.
Absolutely. Let's distill this down. First, develop a comprehensive tax baseline. You need to know your marginal and effective rates to forecast the impact of future income.
Know your numbers.
Second, optimize your compensation. High earners should look at things like deferred compensation to shift income out of high tax years.
Third is probably retirement plans.
Of course. Maximize your contributions to 401ks, IRAs, HSAs. For anyone in their 30s, 40s, or 50s, it's the easiest way to immediately cut your taxable income.
Okay, what's fourth?
Minimize your alternative minimum tax, or AMT, exposure. As the exemption amounts change in 2026, you need to be careful about timing deductions and especially exercising incentive stock options, which is a common trigger.
Fifth, harvesting capital losses.
A classic. If you have investments that are down, sell them strategically to offset capital gains you've realized.
Sixth and seventh seem to be for business owners.
Right. Leverage R&D tax credits. Many small firms qualify now. And utilize amortization options for those R&D costs, which can provide greater long-term benefits.
Number 8 is maximizing small business deductions in general.
Right. Track everything. Use Section 179 for equipment. Ninth, manage your charitable giving strategically. Think about donor-advised funds to front-load deductions in high-income years.
And finally, number 10.
Revisit the Roth versus traditional debate. For younger professionals expecting higher income later, maximizing Roth contributions now, while your tax bracket is lower, is a critical long-term play.
And all of this planning has to happen well before the end of the year.
The sooner the better.
That tax detail is incredibly valuable. Moving to the long game, retirement planning. The overall sentiment around retirement confidence seems troubling.
It is. The Retirement Confidence Survey data from EBRI and NRS shows a multi-year decline in confidence. People are feeling pressure, inflation anxiety, and just general insecurity about their post-work years.
And the sources specifically target those in their 30s, 40s, and 50s. What's the critical mandate for these groups?
For those in their 30s and 40s, the message is save aggressively and diversify. But the strongest advice, particularly for those in their 40s and 50s.
Which connects to that source, I'm 65. If you're in your 30s, 40s, or 50s, watch this.
Exactly. The advice is to stop planning around the assumption of extended work. So many people in their 50s plan to work until 68 or 70. But the data shows a significant danger here.
People are forced out earlier than they expect.
Right. Due to layoffs, restructuring, health issues, over-relying on a longer career is a deeply risky strategy. You need to start serious planning in your 40s, assuming an earlier retirement date than you want.
But what about spending once you're actually retired?
That introduces something called the retirement consumption puzzle. Conventional models often project flat or even increasing spending in early retirement.
But that's not what happens.
No. Qualitative studies consistently show that overall spending often decreases in retirement, sometimes significantly. You're not commuting, work expenses are gone, maybe the mortgage is paid off. You shift to less expensive leisure activities. It suggests you might need a little less saved than the doomsday projections say.
And what are the key facilitators for a successful retirement, according to the research?
Well, financial security is necessary, but it's not sufficient. Key factors are, yes, adequate savings, but also good physical and mental health and strong social networks, purposeful engagement. And interestingly, the use of financial advisors varies a lot. People in their 50s use them much more frequently as the stakes become immediate.
Whereas younger people tend to be more self-directed. We've covered high finance, tactical tools, strategic planning. Now let's pivot to mindset. Strategy is useless without the disciplined habits to execute it. And we're drawing on a massive data set here, the National Study of Millionaires.
This study, with over 10,000 participants, gives us an empirical, not anecdotal view of how real wealth is built. And it confirms that the path to wealth is overwhelmingly consistent and disciplined. It's not about luck or finding the next Bitcoin. It's about building value over time.
So what are the specific wealth-building strategies that keep showing up in this study, the real how-to-get-rich playbook?
It details these fundamental, repeatable actions. It includes investing consistently and maximizing a 401k, often starting very early in life. Another key strategy is owning investment assets, like rental properties. There's a high correlation between wealth and real estate holdings.
And avoiding debt.
Crucially, avoiding consumer debt, especially high-interest credit card debt. And finally, creating real value, either through a high-income career or a business, and investing those returns wisely.
And among the different paths to millionaire status, which one is identified as the easiest and most common way?
The sources clearly identify the saver investor path. That's the most common and accessible way to do it. These aren't necessarily the people earning $500,000 in IB. They're people who earn good incomes, live below their means, save aggressively, and invest consistently, letting compounding do the heavy lifting for decades.
It's discipline over high-stakes risk.
Precisely.
And we have this stark contrast to this in the source, 20 things poor people do that the rich don't. This highlights a difference not just in actions, but in core beliefs.
The contrast is sharp. It focuses less on income and more on habits and psychological barriers. It contrasts the disciplined financial actions of the wealthy budgeting, saving first, focusing on assets, with habits associated with financial struggle, like overspending and impulse buys.
And the belief system is often the differentiator.
It is. Data shows those in financial difficulty often harbor beliefs about fate, a lack of personal responsibility, whereas the wealthy tend to believe they control their financial destiny. And we have to acknowledge the source material from Chicago Booth notes that poverty itself changes your mindset. It can lead to scarcity thinking that prioritizes immediate needs over long-term gain, creating a self-reinforcing cycle.
Okay, let's talk about how people feel about their money. Our sources point to a fascinating disconnect between subjective feelings and objective financial reality.
This is a major finding. Despite the fact that average financial well-being scores have been stable, consumer confidence has been consistently declining. Only 46% of Americans view their finances positively.
So objectively, many people are doing better than they feel they are.
That's what it suggests. Their savings might be up, their debt is manageable, but they feel anxious, maybe due to negative media or comparison culture.
So how do we actually define financial health beyond just a bank balance or a credit score?
A robust framework for this requires looking at both subjective and objective indicators. The subjective indicators are your feelings and worries. Do you feel secure? Could you handle an emergency?
And the objective?
Those are the measurable metrics. A regular, stable income, consistent savings, stable investments, and manageable debt. Good financial health is having both. Stability in your assets and freedom from constant financial worry.
And the way we measure this is evolving too.
Yes, that's the cutting edge. It's moving beyond surveys. Researchers are now using payment patterns as predictors of financial well-being, getting a more real-time picture of consumer stability. And this is vital because financial worries and psychological distress are deeply intertwined. Stress about money diminishes your cognitive bandwidth and your overall well-being.
We started with the relentless intensity of high finance, and we're going to end with the ultimate perspective. The wisdom of centenarians, drawing from the source, 100-year-olds share their biggest mistakes. If you live a full century, what do you regret?
The systematic review on life regrets is profound. It found that 90% of people experience severe regrets at some point. It's just unavoidable. But what stands out is the focus of the centenarians' regrets compared to what younger people worry about.
What did the people who lived the longest regret the most?
The sources are clear. Their regrets are overwhelmingly focused on relationships and the management of time. They regret not spending enough time with family, failing to maintain closeness with loved ones, and critically, making mistakes that severed relational ties.
It's not about not hitting a savings goal.
No. It's about choosing work over a family event or holding a grudge for too long. They regret the time they wasted being worried about things that, in the long run, just didn't matter.
This connects directly back to our first section.
Yeah.
If you're pursuing that intense IB path, which demands all your time and often creates a toxic environment, are you just manufacturing the very regrets that those who live the longest say were their biggest mistakes?
That is the core, unavoidable lesson you get when you compare these sources. The centenarians advise avoiding mistakes that sever those relational ties. They urge younger people to consistently question the value of their life choices. The pursuit of wealth, especially the accelerated kind, if it comes at the expense of presence and connection and family, it's often seen as a tragic mistake in retrospect. They prioritize the human element over the financial spreadsheet.
Before we bring all these threads together, we need to set the stage for the next couple of years. What's the consensus economic outlook for 2026?
The overall forecast suggests a period of steady global growth, led primarily by a resilient U.S. economy. The consensus U.S. GDP growth projection for 2026 is around 2.2%. Oxford Economics suggests the U.S. will likely navigate 2026 without a deep recession, a return to more normalized moderate expansion.
So relatively stable, which is good for planners, but what are the blind spots, the risks we should be watching?
Stability doesn't mean predictability. The sources highlight two key risks. First, the potential for slower global growth than anticipated, which would drag down U.S. exports. Second, and this is crucial, the potential for inflation to surprise on the upside in 2026.
And if that happens?
If inflation reaccelerates, the Fed would be forced back into a hawkish stance, which could destabilize asset markets and increase borrowing costs for everyone.
So manage risk with an expectation of moderate growth, but keep inflation risk firmly in sight.
That's the prudent path.
This has been a necessary deep dive. We've pulled from the demanding world of investment banking through strategic tax planning and right into the ultimate question of life satisfaction. And the synthesis is clear. Financial acceleration is possible, but it requires a blend of intense tactical execution and profound self-awareness about your life's priorities.
Absolutely. The sources reveal that financial success relies not just on pure market strategy, like Tom Lee's aggressive outlook or the mechanics of dropshipping, but on strategic maneuvers like maximizing your tax deductions and a deep understanding of why you're pursuing wealth in the first place.
You can be objectively wealthy but subjectively unhappy. The financial health data shows that.
It does.
That's the vital connection. The job satisfaction data shows people quit the highest paying jobs for dignity and respect, and the centenarians regret losing closeness. The pursuit of money without purpose is a proven recipe for dissatisfaction and regret.
The ultimate insight is that the purpose and the meaning you get from your work and your relationships, that often outweighs the raw dollar figure. You can get a high salary, but if it comes with a toxic culture and relentless hours, the data says you'll probably leave.
And if that relentless pursuit consumes your relationships,
The centenarians guarantee you will regret it decades later.
So we'll leave you with one final provocative thought based on this entire deep dive. If the data suggests that renters report greater financial anxiety, which makes the stability of buying a home psychologically appealing,
Right.
yet the current data shows purchasing a starter home costs significantly more per month than renting, which might require a more demanding, time-intensive job like IB to afford it. How should you balance that immediate financial strain of buying against the risk of spending too much time at that demanding, high-stress job, ultimately jeopardizing the very relationships that the centenarians say matter most?
It's the tension between achieving present financial security and risking future relational regret. The critical life decision isn't purely economic. It's a careful calculus. You're balancing cash flow, psychological well-being, and the limited, unrecoverable resource of time spent with loved ones.
Something to mull over as you build your own accelerated path to wealth and wisdom. Thank you for diving deep with us. We'll see you next time.